The king of Chinese technology, Tencent, has reported their earnings a few days ago. And if you allow me to summarize their earnings in 3 specific slides. The first slide I present to you is their revenue profile growth rate over the past 13 quarters, from around $135 billion in first quarter of 2022 to 180 billion renminbi to first quarter of 2025. And in this 13 quarter period, they have grew revenue by roughly 32%, and that's around a 9.5% CAGR. Not forgetting that 2022 alone was a very tough year for Tencent, with flat to even negative year-on-year growth rates, mainly due to the slowdown in advertising and their gaming division, mostly due to the crackdowns, regulations, and also macroeconomic conditions. Moving on, looking at the gross margin profile, I think regardless of which division you are looking at, every single business segment is trending towards one direction, which is 45 degrees to the right. And they've all been improving their core businesses, improving margins, efficiency, and that reflects in the bottom line margins. And of course, all of which would then translate to one of their highest operating margin they've seen. So with that in mind, we can clearly see that Tencent is winning, and winning on all fronts. They've just recorded record amount of revenue, record gaming amounts, even after the draconian crackdown, record ads, record fintech, record gross profits, record operating profits, record margins, and record portfolio size. Because not forgetting, they do run some sort of a mini Berkshire in their portfolio of companies. Except, I cheekily included, they did not experience a record share price. And as the saying goes, in the short run, the market is a voting machine, while in the long run, it's a weighing machine. And Tencent's weight as a business is slowly being reflected in the stock market. And do you know who else is winning? I'm talking to my Singapore viewers out there. So Longbridge, who's a new broker in town, is currently offering new user sign-up promotion rewards worth up to 800 Singapore dollars. So all you have to do is to open an account using my affiliate link down below, and you enjoy lifetime $0 commission trading for US, Hong Kong, and even Singapore stocks. And in order to enjoy the rewards of different tiers, you just have to fulfill the minimum requirement. And at the first tier, you have to deposit 2,000 Singapore dollars, maintain it for 30 days, and complete 3 buy trades. And you enjoy half an Nvidia share. And by maintaining your funds for at least 30 days, you get a 6% per annum interest boost coupon. On top of all these rewards, you get an additional 18 Singapore dollars cash coupon. If you deposit at least $2,000, you get an additional 6% per annum interest boost coupon. So by stacking these 2 rewards up, you get to enjoy a total of a 12% interest rate boost coupon for 60 days. And if it's the first time you're hearing about Longbridge, they actually have a much bigger presence in Hong Kong. And in my recent trip there, I've actually seen their office under construction. And of course, not to forget that they're currently licensed under the Monetary Authority of Singapore. And this specific new user promotion will end at the end of this month, May 2025. So feel free to use the link in the description box down below to claim your rewards today. And thank you Longbridge for sponsoring this video. Now, to also put things into perspective, I think it's also not the first time that I'm feeling upbeat and optimistic about Tencent's earnings. And we all know, market participants, it's very transparent. There's a very good price discovery mechanism. We all know that Tencent has turned around the corner a lot earlier than many of its other Chinese tech counterparts, and they've been delivering banger results quarter after quarter, which is kind of also reflected in terms of their share price, where I've took the liberty to measure in terms of the max drawdowns. And you can see that actually out of this so-called terrific 10 basket, Tencent is one of the better performing ones. Currently only 32% drawdown from its peak compared to say Alibaba, Pinduoduo, Meituan, JD, etc. etc. So you know they're good, I know they're good, everybody in the market knows that they're good. And also to just give you a little bit more context, I've diligently clocked in the past 17 quarters of their figures in terms of their individual line items, their profit margins, and also their portfolio value. You can see that I think 2022 was definitely a pretty rough year, especially for their gaming division. They were experiencing negative growth rates, and of course the macro uncertainty, which is why a lot of advertisers have pulled back in terms of their spending, which is why you saw this so-called mid-teens negative year-on-year comps. And moving out into late 2023, early 2024, domestic games were also still under pressure. But right now, I think at least over the last 2 quarters, everything is winning. Everything is in the green. You see top line growth rates going back up into the double digits. And their gaming division, both domestic and international, they're clocking in 20 over percent. And online advertising is also coming back with 20+% growth year on year. So I think looking across the board, all of them seems to be firing on all cylinders. But fintech might be the lackluster one. I'll talk more about that later on. But yes, gross profit, they've even talked about it in their latest earnings call, saying that they just crossed 100 billion renminbi mark in first time of their history. On some of the things that I think were positive, so firstly, of course, we have very strong financial performance with very clear operating leverage. So revenue top line was up 13%, but gross profits were up 20%, operating profits were up 18%. And it's clearly a green flag because they are growing profits faster than revenue amidst even this crazy AI investment ramp-ups, which we'll talk more about later on. Now, the gaming business is also back in the spotlight, and they're lapping a lot of all these initial concerns about the regulatory handicap and hiccups. And they've convincingly surpassed many of their past record highs. And they've also credited a lot of the AI involvements in many of these evergreen titles. And to a smaller extent, AI has also helped unlock more potential of monetization in their ecosystem and especially in their ads front. So balance sheet is as strong, if not stronger, with record valuations on their portfolio of investments and also a crazy jacked cash pile. So just to give you some perspectives in terms of their disclosure, they're reinvesting heavily into AI. Their existing businesses continue to generate operating leverage, and this provides them the capacity to reinvest this leverage for the exciting AI opportunity. So their certain GPU AI investments have already started to generate revenue, including improved ad targeting and improved content recommendations, boosting the time spent, and by extension, more monetizable real estate, increased engagement of evergreen games, and also their computing infrastructures and platform solutions. So this is also mentioned in their earnings call, where they are stepping up investments in AI in the form of capital expenditure as well as operating expenses. And the improved ad targeting boosts ad revenues, improved content recommendation, which boosts user time spent and thus ad revenue. So usage of AI within the evergreen games boosts user engagement and thus gain revenue and deployment of GPUs and AI across their computing infrastructure. And on top of that, they've given some sort of a disclosure saying that other GPU or AI investments are long cycle in nature. So there's a natural time lag between making investments and generating the incremental return, and this will temporarily result in a small gap between the revenue and operating profit growth. So this is what they said. During this time lag period, we expect the cost of those GPUs and AI investments to offset the underlying operating leverage. But that said, I think we are confident that our stepped up investment in the longer cycle AI projects will create substantial long-term value for our users, business, and shareholders. So I think on one hand, we are seeing very clear operating leverage. They're pressing very hard on their existing high-quality businesses to create this kind of great revenue. But yeah, at the same time, they're also pressing down hard in terms of their investments and expenditure. So they will kind of offset each other. And I think, in short, this is my own interpretation. They're basically telling us that, hey, don't worry, the upcoming great numbers that you're going to see is still an understatement of their optimal performance. And you'll continuously see the expansion in margins and profits in time to come. So you have to be patient. But so you just have to know that your money is in good hands. We are investing it. We are expecting it to generate great amount of returns in time to come, but maybe not so much in the next 1 to 2 quarters. And I think one analyst did pose the question in terms of what's the ROI cycle that they're talking about. And here, they did say that Tencent has been through many time periods where they have cultivated a new product towards critical mass and substantial popularity ahead of monetizing the product. And the revenue generation would be in a sort of a 1 to 2 year time range. So I guess this is the hint that they're dropping here, where we'll see the optimization in terms of margins maybe in 2026 or probably in 2027. Now, in terms of their marketing services, their revenue grew 20% year on year. They benefit from higher user engagement, ongoing AI upgrades to their ad platform, and a strengthening transaction ecosystem within Weixin itself. And I think this AI involvement in their ad architecture or platform has been ringing the same tune across throughout, both in Alibaba and Tencent. So we are seeing great leap forwards, especially in some of these integrations. So they don't have specific numbers to share, but this was what they talked about in their earnings call with analysts. So historically, banner ads achieved a roughly 0.1% click-through rate, and feed ads achieved a roughly 1% click-through rate. So with the benefit of AI, we have seen that the click-through rate on certain ad inventories can improve towards 3%, for example. And then the question is, what's the upper limit on the click-through rate? But I think that ad click-through rate is perhaps the most important. In terms of the video accounts ad loads, we have kept it fairly stable for the last 6 months now, and it's still around 3 to 4%. So you can see that the ad revenue increase is not necessarily a function of them just front-loading ads and try to beat some sort of an internal KPI or numbers. They are keeping the inventory stable, but yet at the same time, they are seeing such great amount of growth rate, mainly or crediting it to the function of integration of AI here. So this is definitely something tangible and something positive. Now on the flip side, things that might not look too good, they are not investing as aggressively. It can be seen as both a good or bad thing. And free cash flow is generally protected, but are they lagging behind? I think nobody knows. And there is also not much clear visibility in terms of their cloud progress. So I think just the point to note here is the relative aggressiveness. I'm not saying that they're not putting money into investment of AI and their cloud infra, but I think just comparing it to my largest position, because I follow quite closely on Alibaba as well, Alibaba is clear. They're planting their flag here. They're going all in. They are devoting a great deal amount of their cash flow. But I think for Tencent, they're taking more of a cautious approach. They're still managing their cash flow pretty well. You are not experiencing some sort of an evaporation. But I think that's why I say, relatively speaking, Alibaba is a lot more aggressive here. And of course, there is also some sort of a level of execution risk because they're going into an ultra competitive environment, especially into the e-com and also the AI space. So now zooming specifically into their fintech and their business services. So for fintech revenue actually only grew by low single digits %, and their total commercial payment volume declined slightly year on year. On the other hand, which is for the business services side, the revenue returned to teens percentage year-on-year growth. I think it's mainly driven by cloud services and fees being collected on the e-commerce transaction. So they don't have a much more granular breakdown, but I think you just have to understand that fintech, probably as a function of the macro economy, people are not as optimistic, consumer sentiments are not as bullish, and that's why loans growth or a lot of all these products or solutions from the fintech arm haven't grown very substantially. So moving on to the business services arm, they did say that revenue has actually returned to the teens percentage year-on-year growth. I don't think it's high teens because for those of you who have been following, if there is high teens growth rate, they will reflect high teens. Here, I'm probably guessing between 10 to 12%. And they did cite that it's mainly driven by their cloud services and fees collected by the e-com transaction. So they didn't just say that because it was due to crazy amount of demand from their cloud computing services. So that's why I'm a little bit iffy here. I don't necessarily think that Tencent's cloud is performing at a much greater pace or significant pace compared to Ali Cloud here. Now also, if I were to match this to what the management is talking about, they did say that the AI-related revenue within Tencent Cloud grew quickly year-on-year, driven mainly by increased customer demand for GPUs, APIs, and platform solutions, although they're still constrained by limited GPU availability. Just saying growing quickly year-on-year doesn't really signal a lot of confidence compared to Ali Cloud saying that they have grown AI revenue by triple digit by 8 consecutive quarters now. So I think that's really the difference in tone that the largest two tech companies are talking about when they're talking about AI specific related to cloud revenue. And also to just give you a little bit more color in terms of how Tencent is managing their cloud computing division, they said that to a large extent right now, we are putting in a lower priority because especially when there's a short supply of GPUs, then the GPU rental is lower priority to us. And subscriptions, I think, is not the most likely business model for AIs in China. Right now, everybody is actually providing AI for free, so the subscription model, which exists outside of China, I think it's not going to be mainstream business model for AI in China. Long story short, yes, they're not really interested in building out a larger cloud infrastructure so as to support the entire cloud demand in China today, but more so focused in terms of internal usage and the training and the help for their own internal consumption. So that's the difference in terms of how they look at this cloud business specifically. And I think just one final note I want to flag out is that I do believe that Tencent's core long-term focus is definitely in the right place, and I'll tell you why. I think in the earnings call itself, many analysts have been probing the management team, talking about KPIs, looking at the runway ahead, looking at how their advertising arm with this recent more than 20% growth, when you look at this part, there is this huge re-acceleration, even higher than the last quarter of 2024. And many analysts, myself included, we are very excited about this huge growth and how things are going to be like out into the future. And Tencent's management team has given a very spot on and very articulate answer to these questions. So they said that the way we look at our advertising business is that there is a very long runway, and all we do is try to extend the runway rather than to manage the growth rates on a quarter-to-quarter basis. And at the same time, rather than having lesser advertising, we can actually make our product experience better, and that's another competitive advantage that forms a virtuous cycle. I don't think we operate by setting prescriptive KPIs. This is a very long-term project with a very long runway. Again, I keep on going back to the same term, runway, because we felt it's much more important for us to make sure that the business can keep growing for a very long time, rather than sort of go for these sprints so that you have KPIs and then sort of you need it. From here, I think the emphasis is pretty clear. So I think not specific to just the e-commerce and advertising business. I think the general thesis is your ability to believe in the management's vision and the ability for them to continuously discover and unravel new business divisions that is able to provide high quality, long runways of growth that will continuously improve the intrinsic value of the overall enterprise itself. Now, some of my concluding slides, I think I'm very happy and comfortable to be able to continue holding on to Tencent. I'm definitely a proud shareholder. I'm looking at how they've recovered strongly and executing nicely over the past 3 odd years. And despite its current size, I still see a very long runway for growth and execution on the portfolio of businesses Tencent has a stake in. And I also do expect intrinsic value to continue to grow from strength to strength, and they've proven to be a strong long-term compounder. And I don't expect anything different to happen in the next decade to come. There really isn't much to complain about. They've been firing on all cylinders, but I would have hoped for more breakdowns to specific segments of the business, especially their Tencent Cloud business segment, so that I can have some sort of a comparison or benchmark rather than citing some of these third-party sources. But I think that's besides the point. I have not much to complain about, even if they don't break it down for me. And all else said, I think the overhang of policy uncertainty and the operating environment remains some sort of a black swan risk that couldn't be underwritten. But if given the right valuations, especially like the ones in 22 and 23, you can basically write off the whole part of the gaming segment and you're still being offered a discount. And I will count my blessings that things have recovered strongly, but I wouldn't say that it's a guaranteed given the circumstances. Now, clearly, I'm biased, and for those of you who don't know, actually both Baba and Tencent, they are my top 1 and top 2 position in my personal portfolio. Now, in my initial tweet, there was somebody that replied, Tencent is already fairly priced at around a $600 to $700 billion market cap. And some might question, is there really a problem with Tencent's valuation today? I think rough numbers, they're trading at a price to earnings of roughly 22 times, a forward PE of 17 times, and a price earnings growth of 1 times. So just looking at these traditional financial metrics, I think you can say that they're fairly priced, no doubt about it. And also not forgetting that they have a net cash position of roughly 90 billion renminbi, which is $12 billion US dollars, and a $990 billion portfolio value, which is around $137 billion US. So just adding these two together, that's roughly $150 billion. Scraping it out from the 700 billion, you are probably valuing the core business at roughly a $550 billion market cap. And looking at one of my favorite metrics in terms of valuing Tencent as a business, I like to look at their price to operating cash flow. Because if you look at their bottom line net income, they can be distorted because they have to write up and down their investments. But just looking at the operating cash flow, they come from the core business. So looking at them trading at 16 times today, compared to the historical past 10 years, which are closer to 22, 25 times if to eyeball them, they are still trading at a pretty significant discount. But of course, not forgetting the whole crackdown episode coming in from 2021, where investors suddenly woke up to the fact that, there is this black swan event where regulators can come in to destroy the business. Even though I think 5 years on, their business is still pretty much intact, firing on all cylinders, having record revenue, but I think that's besides the point. On the other hand, when you look at a lot of all these so-called relative valuations, when you compare to historical, you have to acknowledge the fact that Tencent was a pretty much very fast grower. Their 5-year EPS estimate growth rate was easily in the north of 30 to 40%. But right now, they are clocking in at roughly 16-17%. So it's inevitable that their relative valuation would come down. But just looking at how things are performing, and I were to compare them to their 2021 counterpart, trading at 20 times, looking at Tencent as a business, such a stronghold, high quality business, 20 times operating cash flow, I really don't think it's a very huge ask. And just doing some very simple napkin math, 20 times compared to the current 16 times, that means that there is still a 25% easy re-rating if you just want them to quote unquote come to my own personal fair value territory. Tencent is trading around 500 Hong Kong dollars per share. To me, I think the fair value of 600 to 650 dollars per share. Right now, I'm not complaining. They have experienced a pretty much huge amount of recovery from my time of entry. So I will just continue holding on to this long-term compounder. So personally for myself, looking at my own entry price, I do see them easily as a 3 to 5 bagger in time to come. Of course, I do have the patience to wait it out. I don't want to be held hostage of my own prediction, but I think this is really just to give you some perspective into how I'm looking at Tencent's valuation today and how I'm positioning it. I'm just holding on. Actually, if to ask me right now, I'm still bullish, still optimistic. I would probably want to add, but I have other portfolio considerations, looking at the exposure and looking at the potential risk reward compared to other positions in my portfolio as well. But I think, this is just my stream of consciousness, and I hope that you enjoyed this discussion about Tencent today. And with that in mind, if you have any comments about Tencent's most recent earnings, feel free to leave in the comment section down below, and I'll see you guys in the next video. And more importantly and hopefully, I'll see you guys on the moon. Goodbye.